Chapter 16, How to Read, Analyze, and Interpret Financial Reports. In this learning unit, we'll be discussing the income statement. We'll explain the purpose and key items on an income statement and learn how to prepare a vertical and horizontal analysis. The income statement. The income statement is a financial report that tells how well a company is performing, its profitability or net profit, during a specific period of time, a month, a year, a quarter, etc. For service businesses, the basic format of an income statement is revenues minus operating expenses equals net income. And for service businesses, we're talking about things like nail salons, hair salons, accounting firms, things like people who don't have inventory to sell. For a retail business, your clothing stores, your Walmart, people who have inventory, your format is expanded a little bit. It's revenues minus cost of goods sold equals gross profit. And then from gross profit, you subtract operating expenses to arrive at net income. And remember, we discussed how to calculate cost of goods sold in a previous chapter. So this is your income statement in a expanded format for you to look at. In section 1, we have the revenues. A is gross sales. That's total earned sales before any returns, allowances, or discounts on the sales. That is what you actually sold. B, less sales, returns, and allowances. These are reductions in price or reductions in revenue due to goods being returned because of defects, errors, and such. When the buyer keeps the damaged goods, an allowance results. C is your sales discounts. Reductions in the selling price of goods due to early customer payment. For example, a store may give a 2% discount to a customer who pays within 10 days. So this is where you record those sales discounts. So gross sales less sales, returns, allowances, and discounts gives you net sales, the actual amount of sales. Part B expands the cost of goods sold calculation that we've already studied. Remember, you start with beginning inventory, add purchases that you made throughout the year, subtract any purchase returns, allowances, or discounts that you have on the inventory. Purchase returns and allowances are when you return an item due to damage, defects, errors, and so forth. The discounts are when you pay early and get to take a discount on an item. So when you have your beginning inventory plus your purchases, less your allowances, returns, and discounts, you get net purchases. Net purchases plus beginning inventory gives you cost of goods available for sale. Cost of goods available for sale less the inventory you still have on hand at the end of the period gives you cost of goods sold. Your net sales minus your cost of goods sold gives you your gross profit or gross margin from sales. From that, you subtract operating expenses, additional costs of operating the business beyond inventory, things such as salary, insurance, utilities, rent, depreciation. You have all these and subtotal them to total operating expenses. Gross profit less operating expenses equals your net income. Some key calculations that you have on the income statement. Net sales. Remember, net sales is your total gross sales minus sales returns and allowances minus sales discounts. Your cost of goods sold. We've already covered this. Remember, beginning inventory plus net purchases minus ending inventory. Gross profit or gross margin is your net sales minus your cost of goods sold. And lastly, your net income is your gross profit minus operating expenses. So let's look at an example. William Burst invested $100,000 in an Australian-based franchise, Rent Your Boxes, purchasing 3 territories in the Washington area. After finding out the company had gone bankrupt, he rallied 10 other franchisees to join him and created a new company, Rent Our Boxes. If Rent Our Boxes had net income of $38,902 with net sales of $286,585, what was the profit margin on net sales to the nearest 100%? So, this is kind of skipping ahead a little bit, and we'll come back to exactly figuring the profit margin percent. Let's talk about the profit margin to begin with. We're only concerned about this last statement. The rest of these sentences are just extra information. So, if we had a net income of $38,902, and we had net sales of $286,585, our profit margin is 13.57%. The calculation for profit margin on net sales is net income divided by net sales. The French bank Société Générale reported in 2019 net income of 23,561 million euros, and its operating expenses totaled 16,016 euros. What is its gross profit? Well, how do we calculate gross profit? Remember, gross profit is net income minus, gross sales minus cost of goods sold to get you the gross profit. Or if you look at it, remember, gross profit minus operating expenses equals net income. So if we know net income and operating expenses, we can back into gross profit. So net income adding back our operating expenses would equal gross profit. So 23,561 plus 16,016, the gross profit would have been 39,577. And that makes sense. Our gross profit should be higher than our net income and our operating expenses. So the vertical analysis of an income statement. When you're doing the vertical analysis of an income statement, you're going to divide each line item by net sales. So net sales is your base. That is your 100%. So let's look at depreciation, for example. In 2020, we had $1,000 of depreciation, and our net sales was $45,000. In 2019, we had $500 of depreciation and net sales of $29,000. So 2020, 1,000 divided by 45,000 is 0.0222 or 2.22%. In 2019, 500 divided by 29,000 is 0.0172 or 1.72%. Again, make sure you're using the proper base to divide by. In preparing a horizontal analysis, we're doing the same thing as we did with the balance sheet. We're going to take a look at cost of goods sold here. In 2020, our cost of goods sold is $45,000. In 2019, it was $40,000. So our increase amount is $45,000 less 40. Our increase was $5,000. 5,000 divided by the old year of 40,000 gives us 0.125. Make sure you're dividing by the base year, the old year, the 40,000. Make sure you're paying attention to which year is in which column when you're calculating these. Also make sure that if it is a negative decrease, or decrease, that you're putting it in as a negative. This expense here for research decreased from one year to the next. So we have a decrease amount and a negative percent.